Picture this. You are a senior cleric in Thrawn. For decades, you wielded absolute power. The oil money flowed, the militias obeyed, the people feared you. You had billions stashed overseas, properties in London, accounts in Dubai, and a system built to last forever. Now picture this same morning today. The currency you control is worth less than the paper it is printed on. The bank you relied on just collapsed. Your generals are asking when they will get paid. And outside your gates, the largest uprising since the 1979 revolution is still burning. The war is not over. The money is almost gone. And the people who were once too scared to speak your name out loud are now chanting for your downfall in the streets of 200 cities. This is not a hypothetical. This is the reality unfolding in Iran right now. We are about to walk through one of the most dramatic economic collapses in modern history, a financial freefall that is reshaping power in real time. We are going inside the numbers that the establishment does not want you to see, examining the decisions that broke the system, and analyzing the forces now converging that could fundamentally change who holds authority in one of the most strategically important countries on Earth. Let us start with the money, because everything else follows from there. Before the missiles started flying, before the protests erupted, and before the world turned its full attention to the region, the economy was already in deep structural trouble. This is critical to understand. The war did not create the crisis. It merely detonated a system that had been soaking in fuel for years. Reports indicate that the fiscal year opened with a budget deficit of around 40%, not at the end of the year, but at the very start. And that was before a single foreign aircraft crossed Iranian airspace. The labor force participation rate had already plummeted to 41%, nearly 20 percentage points below the regional average. Workers were not being lazy or unwilling to contribute. They had simply stopped believing the system could offer them a future worth working for. According to data from the Iranian Ministry of Social Welfare, a staggering 57% of the population was experiencing some level of malnourishment. 57%. This is a country that sits on 10% of the world's proven oil reserves. And then the currency began to crack with a sound that echoed through every market and kitchen. By March of 2025, as confirmed by multiple international outlets, the Iranian Rial crossed a threshold that no currency ever wants to see. One United States dollar now cost 1 million Rials. To put that in perspective, just a decade earlier, you could get roughly 35,000 Rials for a dollar. The Rial did not just fall, it disintegrated. Currency conversion platforms briefly displayed the Rial's value as $0, not because of any legal declaration or formal decree, but because the software algorithms simply could not handle a number that infinitesimally small. The systems were not designed for extreme depreciation at that scale, so they rounded down to nothing. That symbolic zero was more honest than any official statement out of Thrawn. By the end of that same year, the Rial had crashed to 1.75 million per dollar. By the following January, it was trading between 1.4 and 1.5 million. The Minister of Finance publicly blamed a brief 12-day conflict the previous summer, but economists were clear in their assessment. The collapse was driven by sanctions-related drops in oil revenue, chronic mismanagement spanning decades, and a complete collapse of public confidence that had been festering just beneath the surface for years. Food inflation told the full, brutal story of what this meant for ordinary people. According to data from Iran's own central bank, prices rose 6% in the first few weeks of the current war alone. Residents of Thrawn told journalists that some prices have shot up around 40% since hostilities began. Over the course of a single year, bread and cereals rose 140%. Red meat and poultry rose 135%. Oil and fats, the absolute basics every family needs to cook a meal, increased by 219%. These are not abstract statistics to be skimmed over. These are the numbers behind families skipping meals, behind mothers forced to choose between medicine and food, behind the bazaar merchants who finally pulled down their shutters and walked out into the street in protest. The energy crisis has compounded everything, creating a suffocating blanket over economic activity. Since early 2025, power has been going out nationwide for 3 to 4 hours every single day. Half of the country's industry has ground to a halt due to these rolling blackouts. A massive blackout swept Thrawn and several major cities simultaneously, marking a shift from isolated outages to a structural shutdown. When factories cannot run, workers lose income. When workers lose income, they cannot buy goods. When demand collapses, more businesses close. The chain reaction from power cuts runs all the way through the economy, amplifying every other pressure that was already building. Add to this the energy sector's deeply toxic role in the banking collapse. Banks have been used to fund prestige projects, energy infrastructure development, and state-run companies that have become black holes for capital. And when those projects fail or underperform, the losses do not magically disappear. They accumulate on bank balance sheets, disguised by creative accounting techniques and quiet state support, creating an illusion of solvency that was always just one shock away from shattering. Bank Ayande was simply the first to shatter publicly. It will not be the last. And that brings us to what happened next, because the numbers eventually became people. On a day in late December, protests began. What started among shopkeepers and bazaar merchants in the capital spread within days to universities, industrial cities, and sprawling suburbs. The demonstrations swept all 31 of the country's provinces, including areas that had historically been considered loyal to the state. It became the largest uprising since the 1979 Islamic Revolution, with protests recorded in more than 200 cities. The slogans were not subtle. In one chant that went viral across social media and echoed in the streets, protesters cried out, "Neither Gaza nor Lebanon, my life for Iran." The message to the ruling clerics was blunt. We see where you are spending our money. We know what you have chosen over us. The response from the security apparatus was equally blunt. According to monitoring groups, the crackdown resulted in a death toll estimated at several thousand, marking one of the most violent responses to civilian protest in modern history. Internet blackouts were imposed, journalists were rounded up and arrested, and still the protests continued. Now, these kinds of uprisings do not emerge from nowhere. They emerge from years of pressure that finally finds a way out through the cracks in the concrete. So, let us go back and build the full picture of how this financial system got here, because it is one of the most instructive economic collapses of our time. And while we do that, stay with us, because the piece most analysts are missing is what happens to the clerical elite once the money is fully gone. That is where this story gets extraordinary. The structure of this economic crisis rests on three crumbling pillars: sanctions, corruption, and the misallocation of resources. You need to understand all three to understand why the system is failing so completely and so fast. Start with sanctions. Oil exports, the primary source of hard currency, were slashed dramatically following the reimposition of international sanctions. By 2025, exports were running at less than half of previous peak levels. Oil revenues, which once made up over 80% of government income, had been systematically choked off. When an international snapback mechanism was activated, reimposing the measures that had been suspended under earlier nuclear agreements, the effect was immediate and devastating. Assets abroad were frozen. Arms transactions were suspended. Access to the global financial system, already severely limited, tightened further to the point of strangulation. Even long-standing economic partnerships were disrupted when vessels accused of carrying sanctioned oil were intercepted with international support. Add to this the structural rot inside the economy itself. State-run industries absorbed enormous resources while producing very little of tangible value. Corruption, according to watchdog estimates, drains up to 30% of all public contracts annually. And the Islamic Revolutionary Guard Corps, or IRGC, operates not just as a military force, but as a vast, sprawling economic empire. According to budget documents, the IRGC and Law Enforcement Command were granted over half of total oil and gas export revenues, amounting to tens of billions of dollars. That is before accounting for any of the parallel revenue streams tied to the Guard's vast commercial holdings and smuggling networks. This arrangement created a system where the most powerful economic actors were also the ones with the least accountability and the most incentive to extract wealth rather than build sustainable infrastructure. As international financial institutions projected, the economy was on track to shrink for consecutive years, with annual inflation heading towards 60%. One prominent Iranian economist, a former Secretary General of the Tehran Stock Exchange, went further and warned publicly of a potential inflation surge to 3,000%. 3,000. That is not a misprint or a typing error. That is the trajectory of a currency in freefall. And then there is where the money has been going, because it has not been staying inside the country to feed families or fix roads. For years, the clerical regime has poured enormous resources into its regional network of allied militant groups. One group receives close to $700 million per year. Another receives around $100 million. A foreign allied government, before its eventual collapse, absorbed billions in military aid, oil shipments, and credit lines. A movement in Yemen was funded with hundreds of millions to sustain its missile and drone programs. Militias across neighboring states continue to receive funding and equipment. According to available estimates, Iran has spent well over $16 billion maintaining this network since 2012. In a single recent year alone, the average annual proxy budget was estimated at $1.6 billion. The leadership views this spending as essential to their survival and regional dominance. The proxy network extends influence, creates leverage in negotiations, and provides a buffer of deterrence. But as the domestic crisis deepens, ordinary Iranians have made the trade-off explicit. The chants in the streets said it all. The money that should be feeding Iranian families was being sent abroad to fund foreign adventures, and the gap between government priorities and public needs had become an unbridgeable canyon. Here is where it becomes brilliant in the worst possible way for the regime. Every rial spent on missiles in Yemen, on militias in Iraq, or on allies abroad is a rial not spent stabilizing a currency, paying a teacher's salary, or keeping a hospital stocked with basic medicine. As financial analysts have noted, without a massive influx of new funds, the authorities will have trouble making payroll. That is the critical point. The regime is not just losing money, it is losing the one tool that has held the entire system together, the ability to pay for loyalty. Now, let us look at the banks, because what is happening there is one of the clearest signals that this is not a temporary crisis or a passing storm. It is a collapse of the foundation. The banking sector has been structurally weak for years, carrying enormous volumes of non-performing loans tied to state companies, politically connected vanity projects, and insider lending to those who could not say no. The turning point came when Bank Ayande, one of the major private lenders, was shut down. Its deposits and liabilities, worth the equivalent of approximately $5 billion, were transferred to Bank Melli, the largest state bank. On the surface, it looked like a rescue operation designed to calm depositors. In reality, it was the regime shifting a catastrophe from one corner of the room to another, hoping no one would notice the floorboards buckling. The origins of Ayande's collapse were not hard to trace. The bank had become notorious for channeling funds into politically connected projects that generated prestige rather than financial returns. Among them, a sprawling complex in Thrawn, promoted as the largest shopping mall in the world, which became a monument to excess rather than a functional commercial asset driving revenue. Ayande attracted deposits by offering interest rates above official limits, creating the classic Ponzi trap where new money is used to cover old debts. When the music stopped, the liabilities had ballooned beyond any sustainable level. The fallout from covering Ayande's losses required the central bank to create new money out of thin air. That money creation added fresh fuel to an inflation fire already burning above 45%. And Ayande was not alone. Multiple other banks were identified as being under serious strain, including institutions with deep ties to the Revolutionary Guard apparatus. If a bank with that level of structural connection to the regime's security architecture starts to fail, the damage does not stay contained within the financial sector. It spreads directly into the operational capacity of the IRGC itself. As insiders close to the establishment have described it, the economy has become the country's Achilles heel, with officials fearing renewed unrest and growing uncertainty about whether the government can continue to function without a massive infusion of foreign funds. Meanwhile, naval pressure on the Strait of Hormuz threatens to cut off the remaining oil export revenues, a lifeline that still generates an estimated $30 billion annually and accounts for roughly a quarter of government revenue. That lifeline is now under direct threat. The central bank has been responding to the crisis with the only tool still readily available to it: more printing. The largest ever denomination in Iranian monetary history, a 10 million Rial note, was issued this year, just 1 month after putting a 5 million Rial note into circulation. Food inflation surged past 100% in certain categories. When a government's response to economic collapse is to print increasingly large banknotes just so people can carry enough cash for a week's groceries, that is not a policy. That is a stalling tactic against the tide. Let us also talk about what this means on the ground for the average person, because the numbers risk abstracting something that is profoundly human. According to the state's own statistics center, the labor force participation rate has fallen to 41%. That means nearly 6 in 10 working-age individuals are not in employment and have, in many cases, simply given up looking. The monthly minimum wage, which at the start of the year stood at around $180 in equivalent terms, had by the end of the year fallen to roughly $100 in real terms. 4 independent labor associations issued a joint statement warning that maintaining even a modest middle-class standard of living would require a monthly income more than 4 times the minimum wage. That gap is not bridgeable by tightening belts or cutting back on luxuries. It is a structural impossibility, and the government knows it. There is a pattern here that we have seen before in history. It follows a recognizable and merciless sequence. Currency weakens, imports become expensive, businesses cut back, unemployment rises, government prints money to pay its obligations. That money buys less, inflation accelerates, people lose confidence, currency weakens further, and the cycle continues. Each rotation faster than the last until the system can no longer hold the weight. That is precisely where the country is today. And the war, which has been ongoing, has pushed every one of these dynamics into overdrive. What the brief conflict last summer began, the current confrontation has intensified. The Rial lost 60% of its value in the months after that initial war. It has lost a further 8% since the current conflict began. Every day the war continues adds to the bill. Every missile fired costs money that does not exist. Every alliance maintained requires funds from a treasury that is running dry. And here is where it gets truly interesting. Here is the piece that most conventional analysis skips over in favor of military maneuvers or diplomatic posturing. The clerical elite knows exactly what is happening. They are not blind men stumbling in the dark. They see the currency charts. They read the protest reports. They know that the banking system is fragile, that the reserves that once gave them room to maneuver have collapsed from over $120 billion a decade ago to somewhere between 20 and 30 billion today. They know all of this, but the solutions available to them are all the same shape: short-term survival at the expense of long-term stability. Print money to pay loyalists today. Shift bank liabilities to preserve the illusion of solvency tomorrow. Cut health and education budgets to protect security allocations next week. Health spending has fallen below 5% of the national budget, while military and security allocations remain untouched. This is not a government trying to fix an economy. It is a government trying to survive long enough to worry about the economy later. But as the money dries up, the tools of control start to break down one by one. The reliability of security forces is built on compensation. When wages are delayed or eroded by hyperinflation, even the most ideologically committed forces become unreliable. And the broader population, those who have endured years of economic pressure, political repression, and a war that has destroyed infrastructure and cost civilian lives, has been waiting for a signal that the system is finally too weak to stop them. That signal may be closer than the regime thinks. History offers some useful parallels. In Romania in 1989, the government appeared stable until the army refused to continue firing on civilians. It collapsed almost overnight. In Libya, the grip on power unraveled with striking speed once the financial and military networks fragmented. In both cases, the transition point came not from a slow erosion over years, but from a moment when the structure that enforced control simply stopped working. The key insight in both cases was the same. Fear is not an ideology. It is a product of capability. When the state's capability to enforce fear degrades, the fear dissolves faster than anyone expects. Iran's ruling clerics have spent decades building a system that runs on three pillars: money, militias, and fear. Sanctions, war, and mismanagement are eroding the first. External pressure and internal fragmentation are weakening the second. And without the first two, the third becomes unsustainable. Regimes that lose their financial base while simultaneously facing coordinated popular resistance tend to reach inflection points with very little warning. The brain drain is one of the most damaging long-term indicators. More than 120,000 students are currently studying abroad. That number has doubled in just 4 years. Doctors, engineers, and technology workers are leaving in record numbers. Over 4 million citizens now live outside the country, and surveys indicate that 6 out of every 10 university graduates dream of joining them. The very people who would be needed to rebuild the nation after a crisis are voting with their feet. They are leaving before the crisis is even resolved. Meanwhile, the personal wealth of the clerical leadership is itself under attack. Western governments have been moving to freeze accounts, sanction intermediaries, and target properties linked to senior figures of the Islamic Republic. The offshore financial architecture that protected clerical wealth, the shell companies, the property portfolios in global capitals, the cryptocurrency networks, is increasingly under scrutiny. Without access to those foreign assets, the regime is forced to rely entirely on a domestic economy that is collapsing underneath them. When the war ends, that combination will define what comes next, not the battlefield outcome, but the financial reckoning. Here is why the end of this war will be the beginning of a deeper test, not a relief. Peace will not reset the system. If anything, it will expose it more starkly. Reconstruction will demand resources that simply do not exist. Foreign reserves are depleted. Banks are fragile. Sanctions will not disappear overnight. Oil revenue is unreliable. Investor confidence is almost non-existent. The government will be expected to rebuild infrastructure, restore services, and stabilize an economy that has been grinding down for years. And it will face those demands with the same structural limitations that caused the collapse in the first place. There is no easy path back. The system was designed in a way that ties economic health directly to political control. Fixing the economy requires reducing corruption, opening to foreign investment, and reforming institutions. But each of those steps threatens the power of those currently in control. As long as that trade-off exists, real recovery stays out of reach. And if recovery stays out of reach, the pressure in the streets does not diminish. It grows. The clerics built a rule on cash used to buy loyalty and enforce fear. Now that cash is vanishing, the security force's reliability starts to crack. The banking system hollows out. The currency becomes a symbol of lost confidence, a joke that even guards-linked media has started to admit is no longer funny. And the population, one that has lost loved ones in protests, watched wages collapse, seen children go hungry, and endured a war that was not of their choosing, is no longer willing to simply wait. For decades, the wealth of a small clerical elite grew while the nation suffered. The government printed money to pay its followers, while hospitals ran short on medicine. Security budgets were protected while schools fell apart. Billions were routed abroad to sustain proxy wars, while millions of Iranians went hungry at home. That was the bargain at the center of the Islamic Republic's economy. Power in exchange for silence, control in exchange for subsistence. But subsistence requires money, and the money is running out. What happens when a regime that has governed through financial coercion runs out of money to coerce with? History suggests the answer is not a quiet transition or a smooth handover of power. It is a reckoning. The battlefield may eventually go quiet, the missiles will stop, the airstrikes will end, but the financial crisis will not end with a ceasefire. It will intensify once the distraction of active conflict is removed. Ordinary people will be left facing a reconstruction that the regime cannot fund, led by a leadership that cannot be trusted. The clerics will face a population that has borne the weight of their decisions for decades, and that will now watch them ruined, exposed, and stripped of the tools they use to enforce silence. That is the moment the real test begins. Not on the battlefield, but inside the country, in the banks, in the streets, in the gap between what the government promised and what it can no longer deliver. The battlefield will go silent. But what comes next will be louder than anything we have heard so far.